Good morning, everyone. Thank you for joining us. This is the first Capital Management Corporation webinar for 2023, and we appreciate everyone joining us today. We have a big crowd, so thank you for signing up, and we think you'll find this very interesting and helpful as we head into the new year here. On the call with me today is Tim Call, who is President and Chief Investment Officer of Capital Management Corporation, and Mark Livesay, who is Vice President and Senior Portfolio Manager. A couple housekeeping things that I wanted to remind everybody. If you have a question, if you look on your right toolbox, the webcam toolbox, you'll see third from the bottom, you'll see questions. You can click on that caret, type in your question. You can send it to everyone who's in attendance, or you can send it privately to Tim, Mark, and myself. Second thing is we are recording this webinar, so we'll put it up on the website probably tomorrow morning, but you will receive an email that it has been posted and that you can go click on it and watch it. You can also feel free to send it to anybody, your friends or family that you know that might be interested as well. So we will go ahead and get started. So today's key themes and agenda are four things. First is a recession. There's been a lot of talk, particularly in the news media, that our economy will be heading into a recession in 2023. So we'll touch upon that. Mark will actually share our thoughts and opinions on what type of recession that we may be heading into. Is it going to be a soft one or a vicious one? But Mark will address that. Second, Mark also will discuss about inflation. It was obviously the topic of the year in 2022. It will continue to be, and particularly in early 2023 this year. And Mark will discuss what we see moving forward when it comes to inflation. Tim will move into what we are calling new market leadership. With the drastic shift and change within the stock market, there will be new market leaders than there have been, particularly in the last 10 to 12 years, and Tim will share his thoughts on that. And then Mark will wrap up with what do we have from an economic standpoint as well as stock performance standpoint moving ahead, and particularly in the last 2 quarters of this year. So we'll go ahead and get started. On this particular slide, you can see that there have been multiple bull and bear markets over the years, and 2022 was definitely a bear market year. It was the worst performance of equities since 2008. Last year, at the end of last year, the S&P had dropped 19.5%, and the NASDAQ, even worse, 33%. It had dropped 33%. One would think that the bond market might perform better if stocks are going down, but that was not the case. The bond market performed very poorly. In fact, it was the worst ever year-to-year performance for the bond market, down 13%. So the question is, how long will this bear market last? Are we coming out of it? We've had a little bit of a positive news since the beginning of the year. The first couple weeks, 2.5 weeks of trading, the S&P's up almost 2%. NASDAQ's up a little bit higher than that. So have we seen the end of the bear market? We're not procrastinators here, but it's important to note that for all intents and purposes, we've been in a bear market for around a year. So if you look at this chart, and particularly the 2 boxes underneath the heading U.S. bull and bear markets, you'll see that the average duration of the bear market is 14 months. And again, for all intents and purposes, we've been in a bear market for around 12 months, close to a year, depending on what market index you use. It's also important to know that the average total return for these bear markets since 1966 has been a negative 37%. So what's important about this slide is not just the bear market trends that have that have happened historically over time, but it's also important to look at the bull markets. And the bull markets, on average, have lasted about 70 months. And if you see down below, the average total return for bull markets has been a whopping 209%. The point here is really not try to time the market. Mark's going to talk about that at the very end of this presentation because it can be very detrimental. What we have always said here is long-term compounding and staying in the market and weathering the bad times and obviously enjoying the good times is your best friend. So where are we in our economic cycle? And again, are we heading into a recession? Is it inevitable, and how bad will it be? Well, it's important to remind everyone on this call that in 2022, by technical terms, we were in a recession. The first 2 quarters, we had negative GDP, but third quarter GDP rose 3.2%. So if you're using technical terms for what a recession is, then we came out of it pretty darn quickly. So, but why did we go into this recession back in 2022? And the reason why is that we had tremendous growth coming out of the pandemic. And that's pretty normal. When you have a very hot economy, it tends to need to normalize and balance things out. So in the first 2 quarters, we had negative GDP. The economy was normalizing, and the markets were reacting and balancing out based on that. So what are the expectations that we may heading into one? So if you look at this curve, there are signs that we are in the late cycle. Some very strong signs. Labor market, even though it's very strong, is starting to tighten a little bit. We look at job openings reports, and those are starting to decrease month to month as well. So there are less jobs opening up, but there's still a lot of jobs on the market, but it is cooling off some. Obviously, we've seen the price increases at the grocery store, the gas station, and so forth, as well as those who are renting apartments have seen that tremendously. So costs have definitely soared, and the central bank is definitely tightening. They raised interest rates 7 times last year for a total of about 4.25%. Again, what's important to note here is that if it's a recession, Mark will talk about how we think it's going to be a soft landing. And if it is, it will set the stage for a next period of growth and positive performance in the stock market. And it'll do it pretty quickly, again, as Mark will share as well. So with that, I'm going to turn it over to Mark, and he is going to talk about inflation.
Thank you, Scott. Appreciate it. And on this next inflation chart, we included a long time horizon here, going all the way back to the beginning of 2021, in order to provide some context for where we came from. So for the most part, exiting the financial crisis in 2009-10, up until the pandemic in 2020, inflation was under control and below the Fed's 2% target, represented on this chart by the green line. As we all remember, as we exited the most impactful part of the pandemic in 2021, the economy began to heat up. Supply chain challenges were abounding, and the Fed believed at that time that this inflation that had peaked above 2% was transitory. In November of 2021, roughly, the Fed, after multiple months of inflation, not only not going down, but bumping up again in the fall of 2021, the Fed realized that they were likely wrong, that inflation was transitory, and they kind of got their act together. And as inflation continued to rise into the spring of 2022, As Scott mentioned, they finally began to take action, and the first interest rate increase was March of 2022. So these things, interest rate increases tend to work on a lag, but we see that whether it's the seasonal impact of some of the COVID impacts going away or the impact of the Federal Reserve increasing rates, we can say that inflation likely peaked in June of 2022. The last webinar we hosted was in October. I believe it was the day of, or maybe the day before or after the CPI release of that date. And at that time, you could say that inflation may have peaked. And now that we have 3 more data points, I think we can confidently say that inflation has peaked for the cycle. This moderation in inflation has also led to a generally positive market sentiment over the last 3 to 4 months. We were also coming off a very low level at the end of the third quarter in September. So the market has bounced a little bit since then, which feels good for everyone. The Fed has also slowed its pace of increases from 75 basis points throughout the summer and in November to 50 basis points in December, and potentially even 25 basis points at their next meeting at the end of this month in February 1st. So we do believe that inflation will continue to moderate. The pace of inflation growth will slow. However, there are some impacts in the CPI number that make inflation rather sticky. Roughly 1/3 of the index is the shelter component, and one of our prior calls kind of dug into the CPI a lot, so I won't belabor that point. But the way they calculate the shelter component works on a lag, and so we do believe that inflation will be sticky, and it will be very difficult for the Fed to get to their 2% target this year. And when we say difficult, we think it's highly unlikely that inflation will dip below 2% this calendar year. But the biggest part of the move upward in interest rates, so the heaviest of the lifting from the Fed, the move off of 0 and up to 4.25% to 4.5%, has already been done. So the market is anticipating the Fed slowing interest rate increases, which is positive. So the next question is not just on inflation, but on what's going to happen with the economy. And so the next slide gives a range of outcomes possible, although I will note that many of these we think are highly unlikely. But on the vertical axis, it shows central bank tightening versus central bank stimulus. So at the top, it's central bank tightening, and at the bottom, it's central bank stimulus. And along the horizontal axis, we have inflation persisting on the left side of the page and inflation easing on the right side of the page. And then each quadrant kind of has a jargony name. Hard landing, soft landing is something I'm hearing a lot in the financial press. So we all get these jargon terms. So that's basically whether we enter a recession that is deep and bad or do not. So if you think about you're on an airplane, you can have the pilot hit smooth or hit hard, and you feel the hard landing a lot more than the soft landing. We do not believe that the bottom half of this page with central bank stimulus is very likely at all. So we think it's highly, highly unlikely that we will end up with a stagflation or overheating of the economy in 2023. We believe that the soft landing, which is circled in red, is by far the most likely outcome. The way this is defined is a mild recession, or perhaps we've already had our recession and we're out of it. Inflation will continue to ease, and the central bank tightening will slow, so moderate. And that's what we believe will happen. In this case, real wages could continue to decline, but in the stock market, we believe things will broaden out a lot. The hard landing case is harder and harder to make currently due to mainly 2 things. One being the strength of the labor market. So even though Scott mentioned some layoffs are increasing, there are still more openings than people searching for jobs. And also consumer confidence is improving. So you typically don't see improving consumer confidence into a recession. We talked about consumer confidence on the last call, and that bottomed in July. We've continued to see that higher, although it's not high. But those two things are not consistent with a hard landing scenario in our view. And so we do believe we're going to have a shallow recession, or we potentially will avoid recession and have already exited the recession. And in this scenario, would lead to market leadership broadening out from the mega cap dominance that did persist throughout the last cycle. And I will toss the call over to Tim to talk more about what that broadening out could look like.
Thank you, Mark. The longest large cap growth cycles have extended as far as 10 years. They end with the largest market capitalization companies having a disproportionate representation of the S&P 500. This most recent large cap growth cycle was extended by the pandemic and lasted a total of 12 years. Back in 1999 and going into the Y2K technology bubble burst, the 5 largest S&P 500 companies by market capitalization represented a combined 18% of the S&P 500. This was a record. Last year, the 5 largest S&P 500 companies represented approximately 25% of the index, exceeding the previous cycle's record by 7 points. Some of these stocks like Facebook, which changed its name to Meta, and Tesla have since fallen so fast that they are no longer in the top 5. Currently, the top 5 market capitalization companies represent 19% of the S&P 500. In upcoming years, as mega-cap valuation multiples possibly contract, this number might fall back to 12.5%. The 25 largest market capitalization companies still represent a whopping 40% of the S&P 500 index. Every dollar invested in the index has 40 cents going into those 25 companies, and only 60 cents is invested in the remaining 475 stocks. Historically, market leadership tends to change during economic slowdowns and bear markets. The previous 12-year cycle occurred during an extended period of near zero interest rates. However, over the last 12 months, overnight interest rates have risen to 4.5%. A decade of near zero interest rates resulted in excesses. Private equity, unicorns, and meme stocks became common terms. Other creative investments included over 12,000 types of cryptocurrencies, over 1,300 SPACs, special purpose acquisition corporations, NFTs, which stand for non-fungible tokens, which can be an electronic image. During last April alone, 30,000 NFTs were purchased by virtual wallets. These so-called investments were beneficiaries of excessively low interest rates. Now, leadership should change to real companies providing needed goods and services. Most firms will be hurt by continued rising costs of labor and materials. Most publicly traded companies also borrow money and will be hurt from higher interest rates. Investors should avoid firms that thrive from a zero interest rate environment. Investors should buy firms that have pricing power and benefit from higher interest rates. Financial stocks have cash balances or floats which earned little when rates were at zero. With rates starting this year at 4.5%, many financials will experience surging earnings and brighter long-term prospects. Many industrial and commodity firms have old capital bases and fixed costs that don't rise with inflation. So moderate price increases can greatly help these firms expand their profit margins. Overlooked, undervalued stocks of growing companies that generate excess cash tend to greatly reward investors over many cycles. We refer to these companies as cash cows. Many of these firms generate so much cash that they can pay down debt instead of incurring higher interest costs. Some of our company balance sheets are so clean that they have net interest income, not expense. And this interest income is now rising fast and should add to their overall earnings growth. Cash cows can generate so much cash that they do not know what to do with all of this money. This is a good problem to have. Many pay dividends and raise their dividends annually. Over 80% of our approved stock holdings pay dividends, and most of these increase their dividends annually. Over half of the stock market return over the last century was due to dividends. The important point of this slide is avoid unicorns and buy cows, specifically cash cows. Here's a list of traits we want that investors will want their companies to have over this next cycle. These traits benefit investors in most cycles. Several of our company managements tell us that they do not want to pay higher interest rates. Frankly, they don't have to. Many plan to pay down debt this year with their excessive cash generation. Most of our firms have internal capital investment projects. They're expanding to bring their products and services to more customers. Others have acquired strategic assets. An example of just one of our holdings is a company with a leading portfolio of 5G cellular technology patents. Recurring excessive cash generation enabled it to buy Technicolor, a leader in video technology, which had tens of thousands of patents. Well, just a few months ago, Apple's licensing renewal with this firm set a new record for that firm. Then earlier this month, Samsung, Panasonic, and LG Electronics also signed agreements. We expect record revenues and record profit margins to be reported this year. And we expect this trend to continue. This company's market capitalization is less than $2 billion now. That's well off of most professional investors' radar screen. I still think $2 billion is a lot of money. The cash sitting on its balance sheet represents more than half of its equity market capitalization. After some encouragement, management increased the share repurchase authorization for this company to $400 million, which represents about 23% of the shares outstanding at last night's closing price. Meanwhile, we as shareholders continue to receive the regular dividend from the company, which is provides about a 2.4% yield. This is just one example of one of our cash cow holdings. 83% of our approved stock holdings pay dividends. Of those, 2/3 raised their dividends last year. Last night, 3 of our stock holdings announced additional dividend increases. On top of that, about 3/5 of our companies generate so much cash that they repurchase a material amount of their shares. In an environment of recurring inflation, rising interest rates, and slow economic growth, most company managements must focus on survival. However, the managements of cash cows can focus on long-term growth and long-term shareholder returns. This slide shows the traits of future performance. For decades, we have screened over 3,000 stocks that trade daily in the United States. We screen them based on excess cash generation and recurring profit growth. Only 10% of the stock universe passes these screens. 3/4 of those survivors fail our internal fundamental analysis. Then less than half of what remains after that trade at attractive entry prices. And the price one pays for an investment greatly affects that investment return. Investors should avoid overvalued stocks. These can be found in expensive mega cap growth stocks that benefited from the last cycle and the pandemic. Have you heard about a possible recession? It is hard to keep it a secret when everybody is talking about it. So some investors have already priced in a recession. Defensive hiding places like consumer staple food company stocks are now too expensive. Anyway, they face increasing competition from lower cost private label brands. Electric utility stocks are too expensive as well. And they represent little growth with increasing regulations, heavy capital requirements, and rising interest expense. Luckily, economic slowdowns do not last forever. By the time future economic growth becomes apparent, the firms that will benefit will have already seen their stock prices move. Today's undervalued segments include small cap growth stocks. As a group, these are trading 30% below their historical valuation metrics. Communication stocks benefit from increasing consumer adoption of 5G Wi-Fi, IoT, the Internet of Things, and OTT, over-the-top broadcasting. They're trading at roughly a 25% discount to where they're usually valued. Also, many financials and other cash cows are sitting on lots of cash. They earned little from cash savings over the last 12 years. How much did your savings account earn over the last 12 years? Now these firms can easily earn over 4.5% with no added expense. What is this going to do? Well, it will add to their profits and further accelerate their growth in upcoming years. Investors will eventually move on from the current daily talk of recession, inflation, and war. These topics have created great entry points in numerous stocks. Investors will once again seek undervalued cash cows in several segments of the market. We are positioned well for this. Mark, historically, does the stock market move ahead of the economy?
Well, thanks for the question, Tim. I've got a chart that happens to answer that, thankfully. So this next chart is an average of the stock market and business cycle since 1950 to 2021, and it's a 4-year snapshot kind of around recession. So this is an average composite and not a specific time period. But it goes to show that the market does, in fact, peak prior to the economy slowing most of the time, and then the market tends to bottom while the economy is still slowing down or decelerating. So the market tends to peak 7 months prior to an economic slowdown. And then if you move forward, it tends to bottom 6 months before the actual economy bottoms. So this is on average, the time between a stock market trough and economic trough, or stock market peak, and economic trough is roughly 16 months. For 13 of these months, the market and the economy move in opposite directions. For the roughly 3 months at the beginning of a recession, the market and the economy tend to move together. And during non-recessionary times, the market tends to expand with the economy. So if you're looking at this chart, you're saying, well, you're taking an average of a 70-year period, and most of the time they move together, but certain times they don't. That all sounds kind of complicated and unpredictable, and I would totally agree with you. It is complicated and unpredictable, and so we think that it's foolhardy to try to time the stock market based on what economic trends are doing. So we just don't try to look at what the economic trends are doing and time the stock market. We try to pick good companies that are generating cash and can benefit from all the things Tim talked about throughout an economic cycle, because we can't control the economic cycle, and we know that the stock market is going to move differently in the cycle than the economy does anyway. So, and on the next page, we try to belabor this point even more about not trying to time the market. This page shows the annualized return of the market from 2003 to 2022. That's in that dark blue line at 9.8%, roughly 10%. So that period of 2003 to 2022 had a very strong return, annualizing close to 10%, which is near the long-term average. That period was not without volatility. It began shortly after the tech bubble in September 11th. It includes the housing bubble and resulting financial crisis. It includes the Federal Reserve's zero interest rate and money printing experiment. It encompasses 5 presidential elections. And finally, it includes hopefully a once-in-a-lifetime global pandemic. During this period, if you had missed just the 10 best days, so this is out of nearly 20 years, if you had missed just the 10 best days in the market, your return would be lower by nearly 43%. Instead of up 9.8% annualized, you'd be up only 5.6% annualized. And if you were unfortunate enough to miss the bottom or the top 40 days, so not just the top 10, but the top 40, your annualized return over that period would be negative. So you'd have a negative 1.1 annualized return. The unfortunate thing is many of the best days in the stock market tend to be clustered around some of the worst days as well. Since nobody has a crystal ball that illuminates clearly every day, the best thing to do is stay disciplined, not to sell when you're fearful, and on the other hand, not to take too many risks when you're feeling confident. So we would encourage people to stay in the market, and the old adage is time in the market is more important than timing the market, and we would stick with that. And with that, I will return the call to Scott and open it up for questions.
I want to thank everybody for joining us again. We appreciate it again, as I alluded to at the beginning of the webinar. If you have a question, if you look at your webcam toolbar on the right of your screen, you'll see a menu of options. One of them is questions, and there's a caret. You can click on it. You can type in your question. You can send it to us privately, or you can send it to the entire group on the webinar. You will have that option. We did receive several questions prior to the webinar, so I'm going to go ahead and start there. And I don't know which one wants to take this, Mark or Tim, but the question is, tech stocks have dropped quite a bit. Their valuations look cheap. Is it a good time to start buying these stocks?
Well, I guess this is Mark. I can start with that. We look at individual stocks, not sectors in total. So there are some tech stocks, I think, that that are attractive and that we own. But overall, most tech stocks, and particularly lots of the tech stocks that did very well and have had their stock prices come down, 80 or 90%, were benefiting from the pandemic and probably got way out ahead of themselves from a valuation standpoint. So if the benefit from the pandemic goes away, maybe their earnings aren't quite as high as people thought. So those valuation metrics don't look as cheap as you might think they look. One mistake you can make is to look at a stock that was at 100, now trading at 10, and assuming that it's because it's gone from 100 to 10, that means it's cheap. It could be that it should have never been near 100 in the first place. And so that, the correct value is somewhere closer to 5 or 6. And so in that case, buying at 10 wouldn't be very helpful. So we are looking at tech. Overall, we think the sector faces valuation challenges as the pandemic benefits fade away, but there are some stocks that we think do quite well and can continue to do well. So it's a case-by-case basis, as with everything, but generally speaking, we'd probably be underweight tech right now.
Second question is, I am entering retirement. How much of my portfolio should be in stocks versus bonds and cash?
Well, that's a good question. That depends on your risk tolerance, how well you're able to accept market volatility, especially near bottoms, because the last thing you want to do with your retirement assets is sell near the bottom or panic. Normal human emotions are an investor's biggest enemy, and long-term compounding is your greatest friend. So you want to benefit from the long-term compounding, thus have an asset allocation you can sleep with even in the worst of times. We have two portfolios that are dividend focused, our dividend appreciation and our growth in income. And currently they have dividend yields of around 4 or 4.5%. And so a person entering retirement or a retiree who has to draw their first IRA RMD, which is roughly 4% of the IRA, they can do that. They can withdraw that much money from those stock portfolios and still not touch principal. And as your IRA RMD goes up percentage-wise, as a percent of the IRA each year, still you'll be touching very little of the principal. We think during the first 10 years of mandatory IRA RMDs, you would touch less than 10% of principal if you were in one of those dividend stock portfolios. And so it's important to still have stock exposure because you want to preserve your wealth in retirement, and you need to beat inflation. And you're not going to do that long-term in cash and in bonds. So you need some underlying growth, which we believe our companies have that through long-term earnings growth. And so for many retirees, they can be comfortable with 60 to 80% of their retirement assets in stocks. The remainder can be in short-term bonds, which can benefit from rising interest rates. The short-term bonds will mature soon, and you can reinvest them at those higher rates, and thus once again get over a 4% return today just from the interest in those bonds. Now, many of our clients have so much wealth that they don't mind the volatility of stocks, and they're long-term investors, and they've been through recessions and bear markets before. So we do have plenty of clients who choose to maximize their long-term wealth and their kids' future inheritance by being 100% in equities. But in that case, we still encourage many of those clients who are in retirement to make sure that their stock strategy is one of those dividend strategies as opposed to a more volatile strategy, at least for the accounts where they're actively withdrawing money.
Thanks, Tim. Another question we have is, with inflation remaining persistently high for some time, combined with other negative news and debt ceiling issues, is it possible that you are underestimating the possibility of a hard landing, deep recession? Tim, Mark?
It's possible that many things could happen to make it a harder recession. My wife was hesitant to go to Europe last summer because she was afraid of a nuclear war. We went anyway, and if you're going to be a pile of sand, it doesn't matter where you'll be that pile of sand. But bad things can happen, and surprises can happen. But a lot of this is already factored in and priced into the market because people are talking about it. It's not a surprise. When everybody's talking about a recession, then the recession cannot be a surprise. So it could be a worse recession than people think, and that's quite possible. We believe we were already in recession during the first 6 months of 2022, and we exited during the last 6 months of 2022, and we might re-enter. So it might be a double dip recession. Now it is a great big recession if you're a technology worker who gets laid off, and you're young, you've never been through this before, and you don't know what to do. But most American workers have a little bit more security in their job. There's still a jobs shortage, especially at lower levels. But in many fields, in many specialty fields, there are shortages for labor. And so there should still be plenty of employment income for the majority of Americans. So it's just a question then whether your employment income rises as fast as inflation, or are you able to keep up? But given the information that we know right now, we're not worried about a severe recession. If we do enter a severe recession, one of the best places to be are in companies generating tons of excess cash. Companies with rising profit margins, companies that benefit from the current economic situation. And on top of that, there is the pandemic reopening. This will be the first winter of conferences and hotel convention centers being open and active in large cities. There's still some industries rebounding from the pandemic. There's plenty of other good news, but good news doesn't sell newspapers. And so when you turn on the TV every night for the nightly news, you're going to get negative news. They want you to tune in the next night. They want you to give you a cliffhanger, and you have to tune in to see how much worse it gets the next night. You end the nightly news with who shot JR, we'll tell you tomorrow. Well, you're always going to have a negative outlook when you go to sleep, if you watch the news right before you go to sleep. We recommend not watching the news right before you go to sleep.
We have another question what is your view, or do you have a view about the energy sector looking forward?
Yeah, so I think the energy sector is going to be a very interesting sector over the next decade or so. I think it's going to get a lot of attention. So we do have a view where I would say more positive now than we had been 5 to 10 years ago on the energy sector. You do have to be mindful with certain companies. There's a lot of risk in exploration and production. So you're looking for something underground, and then you have to get it from the ground up to the earth safely, and then you have to transport it somehow. So we like a lot of those pipe companies that transport oil and natural gas, and that business is relatively easy and predictable and needed. There's also some specific cases where companies are finding natural gas and using hedges and have great cash flow and can buy back a lot of their stocks. So as with all sectors, we are looking for the individual stocks, and we're doing our bottom-up company-specific research first. But I would say overall, we feel pretty good about the energy sector going forward. We are going to need what you would consider traditional energy for perhaps longer than people thought or maybe would hope. It would be great if we could make energy out of thin air or nothing. It's just we don't have the technology to do that. And so in order to keep people warm in the winter or not overheating in the summer, we're going to need energy for a long time, even if we do try to hand off to a new kind of energy. Some of that old energy stuff is likely to stay around for a long time.
Okay, we have another question related to a specific sector. What do you look for in financials? A number of large banks have just reported large earnings misses, and their prices have suffered accordingly.
Well, large banks can be quite diversified with exposure in different areas, such as brokerage, mergers and acquisitions, and some of those financial areas can have declining business when there's uncertainty or rising interest rates, and so they can be volatile. But when we look at and what we expect when we look at regional banks and moderate-sized companies, they'll have more exposure to actual savings and lending and banking, traditional banking functions, and their profits should grow nicely. Now there are reserves banks take for in case something happens in the future, and so a lot of banks took big reserves before, going into the pandemic, thinking there could be big losses, and then those reserves had to be reversed 1 or 2 years later. So again, with everybody talking about recession, some banks took big reserves at the end of last year or the beginning of this year, and we think some of those reserves are quite conservative and will be reversed probably later this year. Mark covers and leaves the financial sector for us. I'll let him speak for a moment.
Yeah, so a lot of the large banks, or a couple of them actually, had good earnings. I think Morgan Stanley went up, Citi went up, JP Morgan went down, Goldman went down. So it is kind of idiosyncratic. Goldman, which we like, is a much more transaction-oriented business than many of its banking peers. 2021 had incredibly high transaction volumes with equity and debt underwriting, mergers and acquisitions, and things like that. And they made so much money that it was really a tough comp. And so while their earnings were lower than they were a year ago, they still weren't that bad. They still made money. They were still profitable. And so what we look for is companies that have a repeatable franchise. We look for companies that are trading at reasonable valuations to their book value and tangible book value. I like to look at what their interest rate position is if it's a more traditional bank. Most banks are asset sensitive, which is jargon in the financial industry for benefiting from higher interest rates. So you can look through their filings and see what will happen in a parallel shift of the yield curve or even a twist in the yield curve. So, and then the number one thing to think about and be concerned about when you invest in a financial, particularly a bank, is what happens if their loans go bad. So the asset side of the balance sheet is their loans, and you need to be confident that they're going to be paid back. And as Tim said, a lot of these companies have taken reserves, and as they see the economy slowing, they add to their reserves. We think in this cycle, it's likely that they will continue to add to reserves, and that will lower profits, but it will not make profits negative, and it will not lower capital. And one of the things this cycle that might be different from the 2008-2009 cycle, or we believe will be different, is the banks are in much healthier shape. Many traders or investors or people who write algorithms might be taking their cues from the 2008-2009 recession, and when you wanted to just sell every bank no matter what. And that's because all the banks had a lot of bad loans on their books from real estate. We just don't see that happening this time. There's no doc loan. There's no pick-a-pay loan. There's no area that we see a huge problem in the loan book of banks. So we feel pretty good about the financials right now.
I think we have gotten to all the questions. If we missed one, we apologize. Feel free to send it to Mark, Tim, or I, all three of us, and/or give us a call. We appreciate everybody's time today. We wanted to, let me see if we've got one more. Hang on. This? Yeah. We're checking to see if we have one more. Nope, I think we got them all. So, and again, thank you for joining us. We hope you have a great rest of the week as well as weekend. And again, if you have any other subsequent questions after this webinar, feel free to reach out to us via email or a phone call. Have a great rest of the day. Bye.